Hello, everyone. Welcome back for another Friday Fratarcangeli market update. It's been a while. It's been about 3 weeks. Glad to be back in the saddle and talk about July. Here we are post 4th of July, and the markets are under pressure again. Here we are with the tech sector, AI specific, semiconductors consolidating, some other areas of the market sort of rotating to the upside, but overall a great deal of volatility here this Friday morning as well for July. What does that lead next? We're in earnings season. Earnings season is kicking off. The first week, so far so good. More to come on that, but the more pressing geopolitical news. The peace memorandum has now turned into mass bombing again. I don't think many of us are very surprised. We believe that this is the process that is unfolding that will lead us to the ultimate outcome that we're all desiring: peace and prosperity. Here we sit today with what we've endured through the process. Let's not forget the fact that in March's lows, the markets were down 8, 9, 10%, and we had a full reversal today where the market is up over 8% in the S&P 500. If we would have reacted during March, if we would have sold at the lows, we wouldn't be a part of that recovery that I believe, again, with this consolidation, we'll be on the other side of again soon. Stay the course. What's happening right now is the final stages of the Iran conflict. The concern I have, and I think we all have, is that we don't have boots on the ground, which is great for fatality of U.S. soldiers, but what we do have is bombing increasing in mass numbers. And the question is, does our military start bombing the infrastructure of Iran, which we've tried to, I think Trump has tried to deviate from to allow the citizens of Iran to still continue to operate. If that continues, if the infrastructure is broken, the refugee concerns going into Europe will be something we'll be watching closely. More to come there as we watch very closely. As of last night, we had some news come out by our president in regards to the manipulation of our elections coming out of China. Very interesting. I think that's the first real public discussion we've had in quite some time. How that goes next, does it lead to tariffs against China? Does it lead us to another scenario with China that we have to be cognizant of that could impact us on the short term? We'll be watching very closely. I think the fact that we have taken over here in the United States control of the flow of oil, being more in charge of that, could be a bargaining chip that puts us in a strong position. We'll be watching that closely. On the other front, we had data come out this week with CPI and PPI numbers coming out showing softer inflation. What caused inflation to spike during that March and April timeframe was generally driven by gas prices, energy prices, driven by the concerns with the Strait of Hormuz being locked down and the flow of oil impacting the cost and the risk premium coming with it. What we've learned is that that was transitory. We heard that word before. This is true transitory. This was an impact of an event that's now come down in the oil price and caused inflation to tame. And this puts our new Fed Chair, Warsh, in a position to really navigate the situation and take off the potential rate hikes that we're all concerned about recently and actually start considering higher productivity with lower inflation, which could lead to potentially lower interest rates. We've got a dollar that's stabilizing, and we have a productivity environment that I think bodes well for the overall global economy. I think these are all good things. And let's not forget the fact that we are in earnings season. So far, we've had 4% of companies in the S&P 500 report earnings. 90% of them have beaten both on the top and bottom line, pretty close to in line with what we've seen historically. One difference is the fact that we've seen companies come out and increase their estimates for earnings, not decrease, which we've seen over the years. Quarter after quarter, companies come down and guide lower. We're actually seeing companies guide higher. This is a very strong indication of future strong earnings. What we're seeing is top line earnings growth by 12%. And bottom line earnings growth by 20%. Let me remind you, that's the fourth consecutive potential year of double-digit earnings growth. We are in an earnings growth explosion that's driven by AI, driven by tech, but also energy as well. And we're seeing the benefactors that will come behind it that we're watching closely in this earnings season as we keep going throughout the weeks ahead. We're watching how that affects the market as we enter into the midterms. So we have volatility upon us. We have data that's supporting inflation taming. We have the concerns with Iran. We have the election upon us. We have all of these different factors out there. Let's not react. Let's stay calm. Let's stay methodical. Let's understand what our short-term objectives and needs are. and keep our focus on the long term. Volatility is our friend. Dollar cost averaging, staying the course, having a plan, discussing any changes and any of those variables in that plan are critical in these types of environments. The last thing I'm going to leave you with, I've mentioned it before, the second year of a first-term presidency with the midterm election upon us historically is the most volatile and in many cases the least rewarding. But what comes on the heels of that is the third year, post-election, which leads to some of the best performing markets of all of market performing year over year, but specifically in that 4-year first term. The best is yet to come. Stay the course, stay focused, don't get emotional, and don't react to the data and, the noise that sometimes causes us to make changes that is not aligned to our ultimate objective. I look forward to seeing you soon. I'll see you in a week. Bye for now. Good?